Gold has been a symbol of wealth and power for millennia. Ancient civilizations, from Egyptians to Romans, crafted coins and treasures from gold, trusting it to hold value when other forms of money failed. This trust has endured through generations, making gold a unique asset even today. Unlike paper money, gold is rare, and its supply grows slowly, giving it natural stability. When empires collapsed and currencies became worthless, gold remained valuable, a universal form of money. People could carry their wealth in gold coins, accepted anywhere. Gold's universal acceptance and independence from governments make it a safe investment. Gold doesn't rust or tarnish. A coin from 2,000 years ago looks the same today. Its physical permanence mirrors its economic permanence. For centuries, gold was the foundation of money, providing stability to economies. Even though the gold standard is gone, its legacy shapes how we see gold now. In today's uncertain world, financial markets shift quickly and currencies can lose value. People seek safety in something real and tangible: gold. Gold remains a guardian of wealth, a safe place to store value when other investments seem risky. Its long history gives us confidence in its future. Gold is more than an investment, it's financial insurance against the unknown. It's a piece of history that continues to shape our economic lives. Through every crisis, gold has stood the test of time. That's why even now it's trusted as a timeless store of value. What sets gold apart from other assets? 3 qualities: scarcity, intrinsic value, and universal acceptance. Gold is scarce, there's only so much in the world, and new mining adds little each year. Unlike paper money, gold can't be created at will, protecting it from devaluation. Gold's intrinsic value comes from its real-world uses: electronics, dentistry, aerospace, and most importantly, jewelry. Even without investment demand, gold would still be valuable. Universal acceptance is gold's third strength. Gold is recognized and valued everywhere, transcending borders and politics. You can sell gold almost anywhere, unlike stocks or national currencies. This global liquidity makes gold reliable, especially in times of crisis. Scarcity, intrinsic value, and universal acceptance combine to make gold a powerful financial tool. Stocks, bonds, and currencies all depend on institutions or governments. Gold is different. It's an element, a piece of the earth, trusted for millennia. No other asset matches this combination. Gold's value doesn't rely on promises or faith in a system. It's a tangible, enduring store of wealth. That's why gold remains a cornerstone of financial security. Its unique qualities make it irreplaceable in any portfolio. Most investors think of stocks' first ownership in companies with potential for high returns. But stocks are volatile. Prices can plummet during economic trouble. Gold plays a different role, often moving opposite to stocks. When markets crash, investors seek safety in gold, driving its price up. Gold acts as a stabilizer, balancing out losses in stocks. Imagine a portfolio with both stocks and gold. When stocks fall, gold often rises, cushioning the blow. This makes gold a valuable tool for diversification. Gold is like insurance for your investments. That's why I have added links for the best gold investment companies in the description. Unlike stocks, gold doesn't pay dividends or generate income. Its value comes from price appreciation and capital preservation. The goal of owning gold isn't to get rich quick, but to protect wealth. In booming economies, stocks soar, but gold's role is to defend against downturns. Gold smooths the investment journey, reducing stress during market turmoil. It's about preserving what you've built, not chasing the next big win. Gold and stocks serve different purposes: growth versus protection. Together, they create a more resilient portfolio. That's why gold remains essential for long-term investors. Bonds are seen as safe, but they're vulnerable to inflation. If inflation outpaces your bond's interest, your real return is negative. High inflation erodes bond portfolios, especially for retirees. Gold, however, shines as a hedge against inflation. As the value of money falls, gold's price tends to rise, preserving purchasing power. Gold isn't tied to fixed payments like bonds, so it keeps pace with rising costs. Rising interest rates can hurt bonds, but gold's value often endures. In inflationary times, gold protects capital better than bonds. That's why gold is trusted to preserve wealth when inflation strikes. Real estate feels secure, but it's less simple and less liquid than gold. Selling property is slow and costly. Months to find a buyer, plus fees and taxes. Gold, by contrast, is highly liquid. You can sell coins or bars almost instantly worldwide. Real estate requires ongoing maintenance, taxes, and management. Gold has minimal carrying costs. Store it securely and forget it. Property isn't easily divisible. You can't sell just a room if you need cash. Gold is divisible. You can sell small coins or bars as needed. This flexibility makes gold practical for managing finances. Real estate can be a good long-term investment, but gold offers superior liquidity and simplicity. In emergencies, gold provides quick access to cash. No agents, no repairs, no waiting. Gold's ease of use and low maintenance make it a safer choice for capital preservation. It's a straightforward, passive investment. For those seeking safety and convenience, gold stands out. That's why it's a preferred asset in uncertain times. In times of crisis, war, political instability, or financial panic, people flock to gold. Gold's value as a safe haven becomes clear when confidence in governments and currencies evaporates. Its price often surges during global turmoil, acting as a buffer against chaos. During the 2008 financial crisis, while stocks crashed, gold soared. Gold is independent of banks and financial systems, making it the ultimate crisis asset. Central banks hold gold for this very reason. It's universally trusted and holds no counterparty risk. For individuals, gold is not about betting against the system, but about having a plan for the worst. It's financial protection when everything else is uncertain. Gold endures when all else fails. That's why it's a core holding for those seeking true security. In every crisis, gold proves its worth as the asset of last resort. High inflation erodes savings, making cash and bonds lose value. Gold, as a real asset with limited supply, protects against this silent thief. When governments print too much money, currencies weaken and gold's price rises. Holding gold helps maintain your purchasing power. In the 1970s, high inflation devastated stocks and bonds, but gold soared from $35 to over $800 an ounce. Gold owners preserved and grew their wealth during that turbulent decade. Today, concerns about government spending and money printing drive investors to gold. Gold is seen as honest money, immune to political manipulation. Allocating part of your portfolio to gold is insurance against currency mismanagement. In an inflationary world, cash loses value, but gold preserves it. Gold's track record as an inflation shield is unmatched. That's why it remains a vital part of any wealth protection strategy. The most traditional way to invest in gold is owning the physical metal, coins or bars. Direct possession means no counterparty risk. The gold is yours, independent of the financial system. Buy from reputable dealers to ensure authenticity and fair pricing. Store it securely, at home, in a safe, or in a professional vault. Physical gold requires some planning but offers unmatched peace of mind. It's the purest form of wealth protection, trusted for thousands of years. For many, holding real gold is the ultimate reassurance in uncertain times. Modern markets offer convenient ways to invest in gold, like gold ETFs. ETFs let you buy shares backed by physical gold, easily traded through brokerage accounts. They're low cost and simple, but you don't own the metal directly. There's some counterparty risk. Another option is gold mining stocks, which can rise faster than gold itself. But mining stocks are riskier. They depend on company performance, management, and geopolitical factors. Mining stocks can fall even if gold rises. ETFs and mining stocks offer flexibility, but come with trade-offs. Choose based on your risk tolerance and investment goals. For pure gold exposure, ETFs are convenient. For higher risk and reward, consider mining stocks. Each method lets you tap into gold's protective qualities in your portfolio. In a world of financial complexity and uncertainty, gold stands out for its simplicity and safety. Its scarcity, intrinsic value, and universal acceptance make it the ultimate safe haven asset. Gold moves differently from stocks and bonds, providing a crucial buffer in downturns. It shields against inflation and offers superior liquidity compared to real estate. In every crisis, gold has proven its worth as the asset people trust most. Today, investing in gold is easier than ever. Physical coins, ETFs, or mining stocks. The right choice depends on your goals and risk tolerance. Gold isn't about getting rich quick, it's about preserving capital. As we face an uncertain future, gold's role as financial insurance remains as powerful as ever. Gold is more than an investment. It's lasting security for your wealth. Please don't forget to subscribe for more investment tips. Until next time, take care.